You know that feeling, right? The end of the year rolls around, you're looking at your investment portfolio, and all you can see are red numbers next to some of your favorite stocks. It's a gut punch. You feel like you've made a mistake, that you've lost money, and now all you have to show for it is a lower net worth. But what if I told you that those red numbers, those losses you're cringing at, could actually be a good thing? What if those losses could be a tool, a strategy to help you lower your tax bill and potentially even improve your portfolio? It sounds like magic, but it's not. It's a powerful and completely legal strategy called tax loss harvesting, and today, we're going to break down exactly what it is, how it works, and most importantly, how you can use a powerful platform like Newton to do it effortlessly. So, let's start with the basics. What is tax loss harvesting? The name itself gives us a pretty big clue. It's the act of harvesting your losses for tax purposes. In simple terms, it's selling an investment that has lost value and then using that loss to offset a gain you have on another investment. Think of it this way, you have a winning stock that you sold this year, and you made $5,000. That's a capital gain, and you're going to have to pay taxes on it. But you also have a losing stock that you've held for a while, and it's down $5,000. If you sell that losing stock, you can use that $5,000 loss to cancel out your $5,000 gain. Poof! Your taxable gain is now zero. You've essentially just wiped away your tax bill for that gain. Now, this isn't just a party trick for offsetting gains. If you have more losses than you have gains, you can even use those excess losses to offset up to $3,000 of your ordinary income each year. And if you have even more losses than that, you can carry them forward to future tax years, essentially creating a tax-saving reservoir you can tap into for years to come. This is a big deal, and it's a strategy that every long-term investor should be aware of. But here's the thing. This isn't just about selling a losing stock. It's a little more nuanced than that. The IRS has something called the wash sale rule. It's a pretty important detail to remember. The wash sale rule states that if you sell an investment at a loss, you can't buy a substantially identical investment within 30 days before or after the sale. This is a critical point. The government doesn't want you to sell a stock at a loss, then immediately buy it back and pretend you never left, all while getting a tax break. The goal is to prevent investors from artificially creating a tax loss without actually changing their portfolio position. So, how do you get around the wash sale rule and still maintain your investment strategy? This is where it gets interesting. Instead of buying back the same investment, you can buy a similar, but not identical, investment. For example, if you sell a stock that tracks the S&P 500, you could buy an ETF that tracks the total U.S. stock market. Or, if you sell a specific tech stock, you could buy a different tech stock in the same sector that you believe has similar growth potential. The key is to find an investment that will help you maintain your desired asset allocation and exposure to the market without triggering the wash sale rule. This is where a little bit of planning and research comes in handy. This all sounds great, but let's be honest, for the average investor, this can feel like a lot of work. You have to track your gains and losses, remember the wash sale rule, find a suitable replacement investment, and then execute all of these trades. It's easy to make a mistake, and the last thing you want is to mess up and get a surprise from the IRS. This is where a platform like Newton can be a game changer. Newton is a modern, easy-to-use trading platform that has made a name for itself with its simplicity and commitment to low fees. And while they're known for their commission-free trading, they also offer powerful features that can make a strategy like tax loss harvesting incredibly simple. Let's imagine a scenario. You're a Newton user, and you have a portfolio with a few different stocks. As the end of the year approaches, you log into your account. The first thing you'll notice is a clear, simple dashboard that shows you the performance of all your investments. You can easily see which stocks are up and which are down. Let's say you see that your investment in a specific tech company is down significantly. You know you have a capital gain from a different investment you sold earlier in the year. This is your opportunity to harvest that loss. With Newton, the process is incredibly straightforward. You navigate to your losing stock and initiate a sell order. The platform's interface is clean and intuitive, so you're not fumbling around trying to find the right buttons. Once the sale is executed, you now have a realized loss. Now comes the next step, finding a replacement. Newton's platform makes this easy. You can browse their extensive list of available assets, filtering by sector, industry, or even market capitalization. If you sold a specific tech stock, you could easily search for another tech stock with similar characteristics, or even a tech-focused ETF. Newton's platform provides detailed information on each asset, including its performance history, so you can make an informed decision without having to jump to a different website. The beauty of Newton is that it consolidates all of your investment information in one place. You can see your gains, your losses, and your available cash all on the same screen. This makes tracking your tax loss harvesting strategy simple and transparent. You're not flipping between different spreadsheets or trying to remember which investment you sold on what date. Newton's platform keeps a clear record of all your transactions, which will be invaluable when it comes time to file your taxes. But let's dive a little deeper into the benefits of using a platform like Newton for this strategy. One of the biggest advantages is the low-cost structure. Tax loss harvesting involves selling and buying, which means you're incurring transaction costs. If you're on a platform with high trading commissions, those costs can eat into your tax savings. Newton's commission-free trading means you're keeping more of your money, making the tax loss harvesting strategy even more effective. You're not giving up a significant portion of your savings to a broker just to execute the trades. Another key benefit is the user-friendly nature of the platform. We've all been on platforms that feel clunky and overwhelming. They're designed for professional traders, not for the average investor. Newton is different. It's built for simplicity. This isn't just about a nice user interface, it's about reducing the friction and stress associated with managing your investments. When a strategy like tax loss harvesting feels easy to execute, you're more likely to do it. You're more likely to be proactive about managing your portfolio and your taxes, and that's a good thing. It's also worth noting that Newton's focus on transparency extends to its fee structure. You know exactly what you're paying and why. There are no hidden fees or confusing charges that could undermine your tax loss harvesting efforts. This kind of transparency builds trust, and it allows you to focus on what matters, making smart investment decisions. With that said, thanks for watching, and until next time.